While the headlines are telling you about steady global growth, there's a different, much more interesting story unfolding just beneath the surface. We're living through one of the biggest economic splits in recent history. A massive divergence creating a world of huge winners and huge losers that most people are completely missing. In this video, we'll pull back the curtain on the real story behind the numbers. We'll explore why the US and Indian economies are powering ahead, while Europe is hitting a structural wall, risking a future of stagnation. Most importantly, I'll show you what this great split means for your money, and how the investment playbook for 2026 is being completely rewritten. On the surface, the global economy looks pretty resilient. Forecasters like the IMF are pointing to steady global growth of around 3.3% for 2026. They talk about how tech investment and adaptable companies are making up for headwinds from trade policy. But this headline number is a mask. It's hiding a dangerous reality: concentration. The global economy is now balancing on a narrower set of drivers than in any recent cycle. Think of it like a table that's supposed to have 4 legs but is instead wobbling precariously on just 1 or 2. This creates both incredible opportunities in very specific areas and massive vulnerabilities everywhere else. We are seeing sharply different paths forward for the world's major economies. A handful are accelerating, while others are hitting a wall. This isn't just a temporary blip, it's a structural shift, carving visible fault lines across regions and industries. Understanding this divergence is the single most important factor for protecting and growing your wealth in the coming years. At the heart of this split is the United States. While many economies are struggling, the US is outperforming, with some forecasts pointing to growth of 2.5% to 2.8%, well ahead of what many expected. This outperformance is being driven by one dominant structural force: artificial intelligence. But let's be clear, when we talk about AI investment, this isn't just about a few mega-cap tech stocks. The AI boom is a full-blown industrial revolution. The spending on AI, data centers, and the digital infrastructure that supports it all is becoming a new anchor for the entire US economy. Think about the ripple effects. It's not just about semiconductor chips. It's the construction workers building massive new data centers. It's the electricians and engineers installing complex cooling systems. It's the explosive demand for energy to power it all, and all the service companies that support this ecosystem. This spending boom is so powerful that analysts project it will fuel strong earnings growth of around 12% to 15% for the S&P 500. But here's the part of the story that most people miss. This AI-driven boom has a dark side: extreme concentration and sky-high valuations. The frenzy around AI has pushed a handful of tech stocks to unprecedented levels, creating what some are calling the Mag 7 illusion. The market looks like a rocket ship, but under the hood, the gains are shockingly narrow. This has created a winner-takes-all dynamic that's getting risky. Some major investment firms are now warning that because of these extreme starting valuations, returns for US stocks over the next decade could be much more muted, with some forecasts in the 5 to 6% range. We're seeing crowding and record concentration that reminds some of the dot-com bubble. This creates what's known as an asymmetric risk profile. When everyone is crowded onto one side of the boat, it doesn't take much to tip it over. A sudden reversal in these high-flying stocks could spill over into the broader economy. This doesn't mean the AI revolution isn't real. It is. It just means the easy money from simply buying the biggest names might be a thing of the past. If you're finding this analysis helpful for navigating these tricky markets, do me a favor and hit that subscribe button. We go deep on these economic shifts every single week to give you a clear edge. Now let's cross the Atlantic to the other side of this great economic split: Europe. The contrast is stark. While the US is firing on its AI engine, the Eurozone is facing major headwinds. Growth is expected to be lackluster, hovering around just 1.1% to 1.2%. Europe's economy is now in a place where it has to rely less on global tailwinds and more on its own internal power, which is showing signs of strain. Growth is being propped up mainly by government spending, especially on defense and infrastructure. While that's necessary, it's nowhere near as dynamic as the private sector innovation boom happening in the United States. On top of that, persistent structural problems, like aging demographics and a shrinking workforce, are a long-term drag on the continent's potential. With consumer confidence still shaky, a big spending boom seems unlikely. This mix of structural drags and the lack of a powerful growth engine like AI is leading to a sobering reality. Europe could be facing a period of prolonged economic sluggishness. But the story of the Great Split isn't just about a US boom and a European slump. There's another massive winner emerging: India. According to new IMF data for 2026, India is now projected to contribute more to global real GDP growth than the United States, accounting for a massive 17% of all worldwide expansion. So, what's fueling this incredible surge? The IMF points to powerful forces like strong domestic demand, massive investment in infrastructure, and rapid manufacturing growth. Crucially, unlike many other economies, India's growth is primarily homegrown. It's powered from within. This internal strength makes it far more resilient to global shocks. This powerful domestic economy is expected to fuel corporate profit growth of 16 to 17% in the coming years. With a projected GDP growth rate between 6.6% and 7.3%, India is re-emerging as a top destination for capital in a world where real growth is getting harder and harder to find. Together, India and China are expected to generate nearly half of all economic expansion on the planet, a stunning sign of the shifting center of global economic power. So, what does this great economic split mean for you and your portfolio? It means the simple, passive investing strategies that worked for the last decade might not cut it anymore. 2026 requires a new playbook. First, it's time to look beyond the obvious. With US mega-cap stocks facing valuation headwinds, many are seeing more compelling opportunities elsewhere. This includes quality, value-oriented US stocks that got left behind in the AI frenzy, as well as international markets that are less concentrated in tech. After years of US dominance, we could be at the start of a major shift toward global markets. Second, income is king again. For years, rock-bottom interest rates made bonds and other fixed-income assets pretty unattractive. That has completely changed. With yields on various bonds offering attractive returns, fixed income is once again a compelling alternative to stocks, offering both income and diversification. Investors are increasingly looking to source income from emerging market debt, dividend stocks, and other securitized assets. Finally, it's about investing thematically. The AI revolution is real, but the investment story is getting broader. For example, the explosive energy demand from data centers is creating a huge new theme in the future of energy and infrastructure. Geopolitical shifts are creating opportunities in areas like defense and aerospace as nations modernize. The key in 2026 is to move beyond just buying the whole market and build a portfolio that's actively plugged into these powerful structural trends. We are at a pivotal moment. The old story of synchronized global growth is shattering, and in its place, we're seeing the great economic split of 2026. On one side, you have the AI-powered but highly concentrated US market and the incredible domestic growth of India. On the other, you have Europe battling serious structural challenges. This divergence means the risks and opportunities for investors are changing fast. The heavy concentration in a handful of stocks creates fragility, while improving fundamentals in other areas are creating real opportunities for diversification and growth. The year ahead will likely show us whether the AI investment boom can broaden out to lift the entire global economy, or if we are heading into a more fractured world of clear winners and losers. To navigate this new landscape, you have to look past the headlines and understand the powerful currents moving just beneath the surface. What are your biggest economic concerns or questions for 2026? Let me know your thoughts in the comments below. And be sure to check out our other video on the hidden risks in the AI bubble right here. Thanks for watching.